Retire early without waiting for a lottery win. It starts with one boring habit done consistently. Invest in broad index funds. This video is about turning simple math into a real plan you can live with. It's video number 95 in a long-running series about smart money moves, not hype or gimmicks. First, define what retire early means for you. Some people want to leave their job at 40, others at 50. The common thread is freedom from paycheck to paycheck living, not a perfect number on a calendar. Start by listing your essential yearly expenses today, and then think about how those might change in retirement. A clear target makes all the other steps easier to measure. The simplest rule of thumb people use is the 25x rule. If you expect to spend $40,000 per year in today's money, you aim for about $1,000 saved and invested by the time you want to stop working. The math isn't exact, but it's a helpful compass. If you want more cushion, aim for 30x or 35x. If you want less, 20x might work with a lean lifestyle. The key is to write down yours and then validate it with a plan. Now, what exactly goes into the plan? It starts with a simple, low-cost index fund portfolio. Think of three pieces: a broad U.S. stock index fund, a broad international stock index fund, and a broad bond index fund. Many people choose a mix like 60-40 or 70-30 in favor of stocks, depending on how comfortable they are with risk as they get closer to retirement. The goal isn't to chase hot returns, it's to own a big, diversified slice of the global market at tiny costs. Why index funds? They're easy to own, hard to mess up, and cheap. You don't need a fancy stock-picking brain or daily tips from a guru. When you own a broad U.S. fund and a broad international fund, you capture most of the world's growth. A bond fund helps dull the ride and keeps you from selling in a panic when markets wobble. The exact percentages aren't sacred. What matters is keeping costs low, sticking to the plan, and rebalancing once or twice a year. The next piece is tax and account structure. Your first priority is to capture your employer match in a 401k or a similar plan. If you have a Roth option, use it for the part of your gains you want to be tax-free in retirement. After that, funnel money into a traditional or Roth IRA, depending on your income and tax situation. Finally, any extra goes into a taxable brokerage account. Automate every step so you don't have to choose every month. Your future self will thank you for the discipline. Let's talk automation and cadence. Decide a monthly contribution target that fits your life. Then set up automatic transfers to your accounts the moment you get paid. If you can, bump the amount whenever you get a raise or pay off a debt. The habit of increasing contributions over time beats trying to max out everything in a single year and burning out. A practical way to think about growth is to estimate your return conservatively. For many investors, a blended stock-bond portfolio might return around 4% to 6% after inflation over long periods, depending on bonds and stock markets. That sounds boring, and that's the point. The power comes from time and consistency more than anything else. What about expenses and lifestyle creep? The easiest path into early retirement is to live well below your means. Track every dollar for a few months, then cut the silly stuff. It's not about deprivation, it's about removing waste. You'll find that small, repeatable savings add up to real money over a decade or two. Revisit your budget every quarter and prune anything that doesn't serve your long-term goal. A common mistake is neglecting the reality of risk. Early retirees face sequence of returns risk. A bad first few years of market losses can derail plans even if long-term math looks good. Build a small cash buffer, maybe 1 to 2 years of your expected expenses, in a safe place. This lets you stay invested during downturns instead of selling into bad markets. A little restraint can protect your plan when headlines are loud. Rebalancing is boring but essential. If stock markets surge, you'll drift toward more risk. If they fall, you'll drift toward more safety. Do it once a year for simplicity, or set a drift threshold like 5% to trigger a rebalance. Rebalancing keeps you buying low and selling high in a natural, mechanical way. And yes, keep costs minimal when you rebalance. Avoid frequent trading that eats into returns. What about withdrawals in retirement? Start with a flexible baseline. The old 4% rule is a guide, not a law. If you retired at 40, you'll be in this for many decades. So you might aim for 3.5% to leave room for inflation and potential healthcare costs. Consider a bucket strategy. Keep a couple of years' worth of living expenses in cash, then invest the rest in your diversified index mix. If the market dips, you won't be forced to sell at the bottom to cover bills. If it soars, you get the upside, not a forced withdrawal from cash reserves. Healthcare is a real wild card. If you retire early, you'll bridge to Medicare or find private coverage. Start researching costs early, compare plans, and factor premiums into your annual spending target. Health savings accounts can help too if you have access to them. Think of healthcare as a separate line item with its own strategy, not an afterthought. The plan isn't only about investing, it's about habit and mindset. A simple daily habit. Answer 3 questions each day. What am I saving today? What did I do to protect and grow my nest egg? What can I do next month to move closer to my goal? Small daily routines compound into big differences over years. It's not glamorous, but it works. 2 concrete paths you can consider, depending on where you are now. If you're starting with nothing, begin by eliminating high-interest debt and building a $1,000 emergency fund. Then, automate contributions to your index fund portfolio and max out any available tax-advantaged accounts. If you're already saving a bit, aim to increase your yearly contributions by 5 to 10% or more each year. And keep your asset mix aligned with your risk tolerance and timeline. To make this real, here's a practical 30-day action plan. Spend a day listing your actual monthly expenses. Separate needs from nice-to-haves. Then estimate your annual spending in today's dollars. Choose a target portfolio mix you can live with, such as 75% U.S. stock, 15% international stock, and 10% bonds, then tailor to your comfort level. Open or optimize your tax-advantaged accounts and set up automatic contributions. Finally, schedule a quarterly check-in to confirm your plan, rebalance if needed, and celebrate small wins. The social and emotional side matters too. Early retirement can feel isolating if your peers are still in work mode. Find a community or friend group that values long-term planning, not just short-term gratification. You don't have to be perfect. You just have to keep showing up and adjusting when life changes. A steady pace beats bursts of effort that burn out fast. Let's address a few realities head-on. You'll face market downturns, yes, but you'll also have time on your side. Your goal is to stay the course, keep costs low, and make consistent progress. If you lose a job or face a health scare, your plan should still hold up because you built a real cushion and a broad, simple investment core. Now, what if you want a higher likelihood of success without a huge increase in risk? Consider adding a small, more stable portion of your portfolio, such as a bond ladder or a broad-based income fund, to reduce volatility. You're not chasing perfect returns. You're pursuing reliability in the background so your life doesn't depend on a single year's performance. You don't need to live on ramen until age 40 to retire early. You need a plan you can live with, a budget you can maintain, and a portfolio you can trust. Index funds give you that simplicity, but they're not magic. They're a steady engine driven by your choices: how much you save, how you spend, and how you stay invested when markets wobble. If you've made it this far, you already know the core truth. Small, consistent actions beat dramatic attempts that fizzle out. The early retirement dream isn't about luck. It's about showing up every month with the same intention to save, invest, and adjust. Your future self will thank you for the boring, reliable work you do today. If this resonates, here's your reminder. You control the pace. You don't need perfect timing. You need steady contributions. You don't need a perfect portfolio. You need a simple, low-cost one you can own through thick and thin. That's the spine of every early retirement plan that lasts. Now, a quick recap. Start with a real spending target and a shape for your portfolio. Build with broad index funds, keep costs tiny, and automate everything you can. Pay yourself first, and let compound interest do the heavy lifting over years. Protect yourself with a small cash buffer and a sensible withdrawal plan. Review, rebalance, and adjust as life changes. That's the core of retiring early with index funds. If you found a spark in this approach, please like it, subscribe for more practical money talks, and share your own plan or questions in the comments. I read every comment and will answer when I can. This is a community that learns by doing, not by dreaming alone. See you in the next video.